Good morning, everyone, and welcome to the Bloomfield Township Board of Trustees study session, along with the Financial Stability Committee. If we'll all stand for the Pledge of Allegiance. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. All right, good morning, everyone. Is the clerk here to take attendance? So noted. Everybody looks like they're attendant, and at this point, I'd like to appoint our meeting chair as our treasurer, Michael Shostak. The motion?
So moved.
Support?
Support.
All in favor, say aye.
Aye.
Congratulations.
Thank you. You want me to stick the thing up? Well, I'm sure I won't need the gavel, but thank you. Okay. Good morning, everybody. This is the annual investment review for the Board of Trustees and the quarterly meeting for the Financial Sustainability Committee and the Retired Employees Healthcare Benefits Trust. As you know, as the fiduciaries for our investments, for our pension fund and our retiree healthcare fund, the Board of Trustees has the obligation to monitor and advise on the matters of the investments. And so this is our annual study session that we go through it. I don't even have my agenda here, but can I borrow that for a second? Okay, thank you. Okay, so we'll begin with public comment. Since this is an open meeting under the Open Meetings Act, at this time, if there's anyone from the public who would like to address the joint committee, now would be the time. Okay, seeing none, we'll close public comment. We'll move on to approving the minutes of the November 5th, 2025 Financial Sustainability Committee meeting. So members of the FSC, is there a motion to approve the minutes?
So moved.
Motion by Barnett. Support by Olson. All those in favor say aye.
Aye.
Aye. Okay. Hearing no objections, those minutes are approved. Next is the approval of the minutes of the November 5th, 2025 Retired Employees Healthcare Benefits Trust meeting. So for members of that committee, can I get a motion to approve the minutes?
So moved.
Moved by Kolinsky,
Second.
second by Tice. All those in favor say aye.
Aye.
Opposed? Okay, those pass. Okay, now we begin our annual portfolio review, and we begin with the operating reserves, which are the township funds, and apologize here, give me 1 second. Actually, I have the packet up. Where is it here? I don't, okay. Pull it up. So these are the township funds, belongs to the township, and I manage a portfolio with the goal of maintaining liquidity, and so that we have the funds that we need when we need it, and also generating a market rate of return, or as best a return as we can. So you'll see in your packet for December 31st, 2025, we ended the year with a little over $3 million in our checking accounts, $7 million in money market funds, which are readily available. We had $7.5 million in 2 bank certificates of deposit. Those CDs will be maturing, one in March and one in April. And based on where I see rates going, I'm not sure that we're going to renew all 7.5 million of it. We may move those funds. Then we have $56 million in the what I call local government investment pools. We're in 2 local government investment pools. One is the Oakland County Treasurer runs a investment pool for the local communities in Oakland County. So we have some money there. And then the other one is Michigan Class, which is a privately managed pool for local governments across Michigan that includes not just municipalities, but also school districts and authorities. And they have a very competitive return, one of the highest I've seen. And so they're a good 20 to 25 basis points higher than anything we get through our money market funds. So I try to keep as much of the money in there as possible. So we have about $57 million. And that is, the Michigan class is same day available. So if we put in a request for money before 3 p.m., we'll have the cash in our checking account that same day. Oakland County is a next day liquidity. And then lastly, we have a portfolio of fixed income securities of about $40.5 million. This consists of bonds, mostly treasuries, and agencies. So agencies are like the Federal Farm Bureau, and Federal Home Loan Corporation, et cetera. Those are basically government-backed agencies. So they have the same security as treasuries do. They're backed by the U.S. government. And we have about $40.5 million there. The weighted average coupon rate on those bonds is 4.12%. And most money markets right now are in the 3.5 range. So the money markets are 3.5, but they're same-day liquid. The bonds, which are next-day liquid, we'd have to sell security, then pull the money out if we needed it, but we're, of course, not doing that. That we're earning 4.12%, so significantly higher, and that's locked in for a while. So that's the good thing about the bonds. Okay, that is the summary of the operating portfolio. Last quarter, we generated over $800,000 in interest, and we, because of the timing of the bonds, it's every other quarter because we get those interests semi-annually, that the September quarter and the March quarter are when we get most of the interest from the bonds. So you saw in the September quarter, we did $1.1 million in interest versus the $800 in the December quarter. So those are the operating reserves. And at this time, I'll move on to the pension plan trust. So the pension plan trust is, as you know, separated into two portfolios. One is a portfolio that is controlled by Empower, which is the record keeper for our pension plan. They also take care of paying the benefits. And as part of the contract that came from Prudential, which was then bought by Empower, we're locked into a stable value investment called the Guaranteed Deposit Account, GDA, that is managed by Empower. And it's basically a fixed income vehicle, but it's a stable value fund, which means that it can't really go below zero. So we give up some of the upside on that investment, but it can't go down. And so we're earning basically about 3% on that money, and that's being held by Empower. And then they use that money to pay the benefits for the pension plan. And we're locked into that. My predecessor, Brian Keeps, and I, we've looked at every which way to try to get out of that contract because of the low yield that we're getting on that money. As you see, it's $109 million, so it's a lot of money. But unfortunately, that contract just seems to be unbreakable. So we are stuck in that for now. But the good news is that in 2016, the township closed its pension, closed the guaranteed portion of the pension plan. So the number of retirees that are going to be funded by the GDA are locked and closed, and over time that will come down as those pensioners no longer collect pensions. So the second portfolio is the portfolio that we manage with our advisor Mariner and Brian Green, and he'll talk about that here. So this is totally within our discretion how we invest it. Back in 2014, the township sold pension bonds to fully fund the pension plan. Since then, there's been a little bit of a slide backwards. We're not fully funded, but we're about 90% funded. And we use that money to invest and generate a higher rate of return. So I will let Brian talk about that. That's about $130 million. And so, Brian, I'll turn it over to you to talk about the pension portfolio.
Thank you, Michael. Good morning, all. So I'll roll in. The book that we have on screen and in front of you is a combination of an update on the pension plan, and then the second half, the front half of it's for the pension, the back half of it's for the retiree healthcare. So obviously a little different from an asset allocation standpoint, but a number of the names are similar. So I've had the pleasure of being in front of this committee a number of times before, and I always try to come up with like some theme, and I try to come up with a new one from one quarter to the next, but I don't have a new one this time. So the theme this quarter, similar to last quarter, is the news is good, not great. And what's the distinction between good and great? Well, great is positive and outperforming. Good is positive but underperforming. The story of 2025 was really, if you made the decision on January 1 to invest in the equity market, whether it was US or international, that was the single best decision you could have made. But if you, however, then made the distinction of saying, well, I'm going to buy stocks, but I want two components of everything that I own. Number one, you have to sell things, so you have to have revenue. And number two, you have to have profits. So the audacity of saying, I want to buy companies that generate revenue and generate revenue that then results in a profit to shareholders, those were the two worst decisions you could have made. Those two decisions are the distinction or the driving factor between good news versus great news. And I'll give you a couple of examples. So always talk about kind of broad equity returns. And I know we are 9 months into the fiscal year for the township, but 2020, December 31st is kind of putting a bow on things from a personal standpoint. So, looking at last year, the S&P was up 17, almost 18%, great news. Small cap stocks here in the US, measured by the Russell 2000, were up 12%, almost 13. The story was really international markets. The MSCI EFA, which would be Europe, Australia, Far East, was up north of 31%, and emerging market stocks were up north of 33%. So for the first time in a long time, we saw significant outperformance from international stocks versus US stocks. Now, what gets a little bit more interesting, and to kind of lay the groundwork for the driving force between good, not great, is if you start to split hairs a little bit. So I just mentioned the S&P 500 and the Russell 2000. So S&P and Russell are two different market data, market index providers. Why do we use one versus the other? Unfortunately, my answer is the bad one. That's just the way it's always been, right? You hear the S&P 500 in the news every single night. You hear the Dow, you hear the NASDAQ. But they're built a little differently. And the best example that I can give you is if you look at the Russell 2000, which would be a proxy for small cap stocks here in the US. The only restriction is you have to fit a certain market cap range, and it's about 500 million to 10 billion in value, which isn't that large when you talk about like Walmart just graduated into the $1 trillion club. So 500 million to 10 billion in market cap, and 2,000 names. The only requirement is that you fit that range of value of market capitalization and be a publicly traded stock in the US. So that was up 12.9% last year. If you instead said, let me look at the S&P 600, which has 600 stocks, that has the exact same market capitalization range, so 500 million to 10 billion. The median market cap is the same, the average market cap is the same, so the pool that it's selecting from is identical to the Russell 2000, but there's one distinction. To be included in the S&P indices, you have to have 4 straight quarters of profitability. That is the reason why Tesla wasn't in the S&P 500, despite when it finally met those standards, it was now a top 10 name. Last year, the S&P 600 was up 6%. So, index fund buying the same range of companies in value, but the one distinction is 4 straight quarters of generating a profit. It was up 6, not up 13. So I mentioned that from the standpoint of it's really easy to come in and deliver positive news. It's even easier to come in and deliver positive news that are ahead of benchmarks. But that underlying current of profitable companies weren't rewarded as well in 2025 as unprofitable. And it really comes down to the prospects of what AI is going to do to your business. And if the prospect or the perception was that this is going to be a positive disruption, your stock did well. If it was a negative disruption, your stock got hammered. And if it was no disruption or we really can't figure out what it's going to mean, the stock languished. And one of those examples, Rob and I were talking before, like I have a 7-year-old, a 10-year-old, and a 12-year-old at home. So there's a lot of snacks that come through my house. My 7-year-old loves extra cheesy Cheez-Its. That's Kellanova, right? Spun out of Kellogg. They generated 10% more cash on their balance sheet from Jan 1 to December 31st. So the company, right, the balance sheet, the bank account had 10% more cash because they sold snacks at a profit all year long. Stock was down 20% last year. Why? Because AI wasn't going to have any disruption to their business. That seems to be the only explanation. So I provide that as a bit of backdrop into, as we get into the numbers of, we've seen underperformance from a number of active managers, and it's simply because they had the audacity to say, I want to own stocks that sell things and sell them at a profit. My favorite chart, when you go into page 4, dating back to 2014, bond issuance, right? The county traded, the township traded, a certain liability for an uncertain liability in funding the pension plan. Moved into an arbitrage, right? We have to pay interest on this debt, and as long as we can invest these dollars in the equity markets, in real estate, in fixed income, in private equity, and generate a return higher than what our interest cost is on the debt, we're in a good position. Well, we started 11 years ago with $84 million. We have had net negative cash flow, so this is distributions from the equity portfolio into the GDA with now Empower of $32 million. It's generated a 9.04% return annualized over that 11-year time period, or in dollar terms, the stock portfolio, the little bit of fixed income, the real estate, the private equity has added $82.6 million in value. That $84 million today, without any market growth, would be worth the $51 million you see in the bottom right-hand corner. And I will make a concerted effort to make that font size bigger for everyone's advantage going forward. So to the question of, was this prudent and wise? The answer still is an unequivocal yes.
Excuse me, and at the time that we did that, our hope and expectation was that our return would be about 6 or 7%. So we've certainly outperformed what the expectations were back in 2014.
Right. Thank you for that, Neil.
Right, and I would add that the bonds that we sold we're paying interest on it between 2 and 3%. So that money that we're paying 2 or 3% on, we're earning 9%.
So where do we sit? As I'd mentioned, good, not great. For the quarter, up 2 and change on a fiscal year-to-date basis. Remember, this is about half of the portfolio. So we're trying to get to a 6 or 7% return, and the equity half of the portfolio so far in this fiscal year has generated better than 17%. So if Q1 of 2026 is flat, this is always that point in the fiscal year where I say, let's not get greedy, just hold the line from this point forward. The investment portfolio will be push up the funded ratio, right? Because we will have done better than the actuary expected. So I'm going to focus on that 1-year column because I spent some time on the front end talking about what went on, right? And what it all comes down to is if you had the audacity of buying profitable names, you underperformed. So Ancora for the year was up just shy of 9% versus their benchmark up 15.9. I found this interesting, and I know I'm tossing a lot of numbers, but again, we talked about Russell versus S&P 500. So the Russell 1000 value, which would be a proxy for large cap value stocks, was up 15.9 last year. The S&P 500 value was up 13. So saying, give me large cap value names, but give them to me that actually generate a profit, and you gave up 3% in return. So about half of Ancora's underperformance was just market driven. The other is a little bit more on the AI side, is they've had a lot of exposure to Microsoft and Broadcom, and a few investment banking names like Houlihan Lokey that, despite generating better than estimate profitability, stock prices still traded off. However, we have a balance of active managers and passive managers. One of the largest positions is the S&P 500 index fund, and it was up 17.8, and the index was up 17.8. So there's the balance back and forth. Siegel, Bryant, and Hamel, new addition to the portfolio. This replaced the Clarkston portfolio that was removed for underperformance. Slight outperformance in the first 2 months that it was in the portfolio. Outperforming again here in Q1. And I did the thing you're not supposed to do when I was getting ready last night, which is go back and look at an investment manager that you terminated. I went back and looked, and Clarkston has continued to underperform, and Edgewood has continued to underperform. So those changes that were made in 2025 with several of those underperforming strategies have been additive to the portfolio. Reinhardt, as I mentioned, again, that distinction of the S&P 600's up 6%, the Russell 2000's up 12. What's the difference? Profitability. So this isn't we picked the wrong name or we didn't have enough information technology. This is just simply last year the market did not reward high-quality, profitable companies. They are up 7, benchmark was up 12. Long-term numbers for them continue to be in line. This was added back in beginning of 2024 to diversify some of the Clarkston exposure. If we look back, and we don't have it here because this is just our exposure, but like their 3-year number is ahead, their 5-year number is ahead. So everything from a longer-term standpoint continues to be very, very strong. Still an index component in the small mid-cap side, up 11 and change for the year with the Fidelity Extended Market Index Fund. Flip you ahead to page 6. International equity was the single greatest contributor. We own an index fund here, so just choosing to own everything. AI was obviously the driver of things from a U.S. standpoint. European defense was the driver of things from an international standpoint, as big push from a NATO standpoint for more spending within Europe. ABS from an emerging market standpoint, great start. That was added back in March of 2025. Recall that one is a little different in how it's built. It is built of 26 different country-based emerging market equity portfolios. So if we own equity in South Korea, it is a manager based in South Korea that is building that portfolio, or in South Africa, or in Brazil, rather than a team sitting at a trading desk in New York and deciding these are the names we're going to buy. So they are equal weight, some of the largest names like Alibaba, Tencent, and Samsung, but overweight a lot of smaller names in those emerging markets. So a lot of, I'll say, domestic exposure in that they're buying stocks in India that are benefiting from Indian consumers, or they're buying stocks in South Africa that are benefiting from South African consumers. Not global trade, but domestic trade in each of these countries. Negative spot in the portfolio, so about 1% of the underperformance that we saw for the last year is because of write-downs that we saw this year in the TerraCap portfolio. This is reflective of them making some painful decisions within the portfolio of several properties that, because of appraisals and because of debt coming due, were sold. So they have a number of properties that were being sold in the fourth quarter and first quarter that were appraised in the third quarter. They knew what those exits were going to be, and they just wrote all of those to what they thought the exit price would be. I'm not going to use the word optimism. Like, this is a negative spot in the portfolio. If this were a U.S. equity portfolio, this would be a stock that we got wrong and would have been sold. But because this is an illiquid portfolio that will be worked out over the coming years, it's something that will continue to be there. It is a small part of the overall allocation and was intended to be that way. And what it comes down to is 2021 is going to be one of the worst vintage years for investing in real estate because 22 happened with significant rate increases, which meant commercial real estate prices declined. That's offset by some good news out of the Bloomfield Capital Fund. This is real estate lending. You see up 8% for the year for one of the tranches and 4% in the Principal Enhanced Property Fund, which is U.S. commercial high-quality real estate, diversified by property type, diversified by geography, seeing positive news there in that portfolio, up 7% for the year. The offset that I'll give you to the TerraCap's negative 42 is Capital Dynamics, which is the private equity portfolio that was added back in 2024, was up 42% last year. That is really reflective of, that is a secondary portfolio, so they are going out and buying existing interests from private equity investors, typically at a discount, right? That is an institution that decides they don't want to own private equity anymore. a group of individuals decide that they don't want to own a private equity fund anymore, and Capital Dynamics specializes in purchasing those interests. I expect that number to come down. You know, it's done 27% since it was added to the portfolio back in October. The expectation over the life of the fund is kind of 15 to 20%. But nice to see a private investment right out of the gate do phenomenally well. And then finally, the new addition to the portfolio, and this was just a conversation that the treasurer and I were having around, we have some cash that will ultimately be deployed. We have some upcoming needs to make transfers to the GDA for pension payments and MIFL obligations. But with short-term rates decreasing, what can we find that is conservative, safe, liquid, but attractive from a yield standpoint? And that was where at the end of the year, the Baird Ultra Short Bond Fund was added. And it's yielding something just north of 4% versus 3.5% out of money market and liquid on a daily basis. So as long as we enter a trade by 4 p.m., we have the money ready for us the next day. So go back to the beginning. Story is good, not great. What it comes down to is, and we've seen it here in January and February, is the market turns quickly and it's now rewarding the audacity of selling things at a profit. So pleased with the numbers that we've seen just in terms of how strong they are. Disappointed in the underperformance we've seen from several strategies, but understand what's driving that underperformance and recommend continued patience. Questions?
Yeah, Brian, I got a couple of questions. You were talking about commercial real estate. I've been talking to some developers, and their office space, general open office space, was down. Their vacancy rate was at, and I'm speaking of one in particular company I know of, they were during COVID at 55%. Now it's really picked up. They're at 75% occupancy. The industrial properties are 100% full. And then we have other developers in the area, I can point out to you, that are buying real estate like office space and turning it into apartment buildings or condos. Is that reflective in when you were talking about commercial real estate and the investment, or is this like something we need to start paying attention to?
So I would say that positive news and that optimism is what's being portrayed, for example, in Principal's numbers. TerraCap's numbers, because Principal is an evergreen vehicle. So they're on a regular basis purchasing properties, selling properties, and kind of refreshing the portfolio. TerraCap's issue is everything that's in that portfolio was purchased in 2021 from a peak and really at a peak valuation standpoint. So it's reflective of the interest rate increases that we saw in 22, which then trickled over into the commercial real estate market in 23 and 24. What they face is, interestingly, what's probably creating the opportunity for a lot of the examples that you just gave is the developer working that property right now is purchasing it from someone that bought it in 2020 or 2021 with a 5-year mortgage that's now coming due. And because prices have come down, the choice is, do I put more equity into this? Because the bank won't just, right? It was worth 10 and I borrowed 5 and now it's worth 7 and I owe 5, but the bank's saying, you owe me 5, but if I'm gonna renew the mortgage, it's only gonna be at maybe $3.5 million. So that's where developers have to make that, or building owners have to make that decision of, do I just give it back and redeploy my capital elsewhere? In TerraCap's situation, I think it was 3 office buildings where loans were maturing, and we can throw more money at this or take the loss on these 3 to be able to protect the rest of the portfolio that is, 95% occupied apartment buildings in Austin or Orlando or Atlanta, and have a better chance of recovery on those properties versus these that are probably going to languish for a little while.
In other areas where population is shrinking?
How much money do we currently have in TerraCap? Is it on the sheet?
1.3 million. It's on page 8.
Well, that's the current value.
Current value.
Was 1.3. We probably had
2.5?
2 to 3 in it.
Yeah. It was $3 million was the commitment.
Okay.
We did see an initial distribution right out of the gate on that
I
one.
remember, yeah.
They had an apartment building in Sarasota or Bradenton, Naples adjacent, that they bought and owned it for about 6 months, and somebody came in and made them a sweetheart deal.
And that was right after one of the hurricanes, right, that they weren't
Yep.
affected, so they.
And it was one, as I recall, because that's the view of, if you live in Florida, you don't own on the coast, you own inland. You visit the beach, but you own inland because of the hurricane risk, and they said they had, I think it was 3 screen doors they had to replace. That just for whatever reason, the way the wind, everything came through, that building was unscathed.
So we're currently at a 19.65% value mark on that investment. That doesn't mean we've lost all that money. It means that's what the value of the investment is today.
Correct.
So it is possible that if the market turns or a little, over time, I mean, this was intended to be a 7 to 10 year investment.
Right.
And it's only been 5 years.
5.
So over the next 2 to 5 years, we could see a reversal in that, and we could end up getting more of our money back. But if we were to liquidate today, we would take a 19.6% loss.
Right. And I think
but-
there's 2 important components of that. That value is reflective of TerraCap's choice to appraise every property every quarter. So take the good, take the bad, and recent appraisals have been taking the bad. If we see any decline in long-term interest rates, which is a big push from an executive branch standpoint, if you see the 10-year come down, you're going to see a significant recovery in the value of that. So they're operating the way that they should be. If we get a different interest rate environment, that will be a tremendous beneficiary to that portfolio.
Right. Because that's a defined set of investments that fund has that we are invested in. So I could give you the list of buildings with addresses that we are invested in through that fund.
Right.
Right, and that's not going to change. As compared to the principal fund, which, as Brian said, is an evergreen fund, so they're constantly turning over the portfolio, buying and selling, and we're only showing a 1.3%, 1.4% increase on that over the life of our investment. But we're also getting cash every quarter.
Mm-hmm.
They're sending us a dividend, a distribution every quarter for that property that we are not reinvesting with them, that we are taking that cash and it sits in our cash account until we make other investments. So we are putting to work the dividend that we're getting from it. Likewise, with Bloomfield Capital, which is a private credit or a real estate credit fund, we are getting a quarterly distribution of cash that we are putting to work in other investments. And if you look at their mark to market on those 2 funds, they're showing about a 9.5 to 10% IRR or 9.5 to 10% annualized return on our investment since we've made it. And so, but we're seeing that cash come every quarter. Now that's also, it's not exactly evergreen, but they have in their plan document, their fund documents, that we will continue to roll over our investment into new funds, into new series of funds. So right now we're in Fund 5, Series C and D. They're starting to raise capital for Fund 6. And we are, at present, signed up to roll over our investment into Fund 6. We can stop that. I think we have until April to say, nope, we'd like our money back, rather than rolling it over. So that's a decision we're going to have to make going forward. But so far, I've been very pleased with that investment. The reporting is excellent. They're giving us our quarterly dividend, like clockwork, and we're continuing to see value in the way that they do it. They make short-term loans, so they do basically bridge financing on real estate. So if an investor wants to buy a property, they will give them a 2-year loan or a 1-year loan on that property. It's got to be paid back right away. It's all first lien debt. So, we're at the top of the capital stack. So it's very secure, and that's been generating good returns. So for now, I think that we should just keep rolling with that investment going forward. Principal, we can get out also. The liquidity there is probably a 6-month timeframe. If we put in a request for our money back, it'll take about 6 months for them to get us our money back. But as we talk about how we want to allocate the portfolio, and Brian's going to go into that, I think, on the next page, we have those levers between Bloomfield and Principal that we could pull money out of real estate and redeploy it if that's something we wanted to do. So, Brian, why don't you talk us through our allocation strategy?
Yeah. So where we are on page 7.
Since you're on that topic, I've got a couple quick questions.
Sure.
How much cash is being generated to meet the pension obligations by those accounts?
You're talking about through the real estate?
Yes.
So we get a 7.5% distribution on our Bloomfield investment every quarter.
Okay.
An annualized 7.5%. And I haven't calculated, I can calculate what the principal is. I think it's closer to, what, 1% maybe, 2% a quarter that we're getting?
It covers a nice portion of what we owe.
Yeah, so, but I was gonna get to that a little bit later in terms of how we're funding the pension obligations.
Okay.
But right now, we have enough cash with, and power to fund our investments. But going forward, we're gonna have to come up with a new funding strategy. So if we could come back to that at
Okay.
the end.
Okay, thank you.
Yep. And he's actually gonna address some of that as we talk about our allocation strategy here. We're gonna talk about reallocating to allow for more cash flow to be able to meet our pension obligations.
Yeah, so this is kind of we've reached the point of maturity with the pension plan, that we're kind of at a tipping point where we have more cash flow needs. So this is where we start to spend down start to slowly spend down what we saved for all of these years. So much the same as for any of us as an individual, we reach that point in our career where we're no longer getting a paycheck, no longer have to wake up other than a day like today, and put on pants that need a belt. Right, so the tipping point of being in retirement and now spending down the nest egg that you've put together. So we're at an inflection point with the pension system such that we're now starting to have cash flow needs. So this is where you're starting to see things like fixed income being added in. Not at a 30 or 40% allocation that you might see with others, but at a 5 to 10%. The idea being, and this is where Michael and Jason and I are in ongoing conversations around, what do we need for the next 3 months, next 6 months, next 12 months, and using that on a continual basis to make sure that if we have a pullback in the equity markets, that we have the next 6 months of cash flow covered, so that we don't have to sell something at a loss to cover a known cash flow need. So that's where, if you compare this to others, you see things added in here like we now have a fixed income allocation. When we talk about the investment policy statement later, you're going to see a target to fixed income because we now need to have some because we have cash flow needs. The overweights you see here, for example, to U.S. equity, particularly large cap and international, are driven by two pieces. Number one, the success of both of those. They keep growing. And number two, because we are underweight alternatives. And simply put, rather than just having the money sitting in cash and earning 3.5%, waiting for it to go to work with Capital Dynamics or a new private equity fund, that money is invested in the rest of the portfolio and earned 17 and 30% last year in the S&P 500 and in international equities. So the other piece you see here is an underweight to real estate. That is intentional, right? As the portfolio has grown, we should be adding more to we could add more to real estate, but we've made an active choice not to. One of the pieces that you will see later on is reducing the target to real estate, such that we're not deploying new money into that asset class. It's allow the existing stuff to continue to work, but deploy those funds that were expected to go into real estate into other parts of the portfolio.
Okay, so the goal here, and we can talk about it when we get to the investment policy, but basically what we're looking to do is trim some of our equity exposure and increase and have a fixed income component. Now, Brian mentioned that other systems, other pension funds have like 30% allocated to fixed income, whereas right now we're only talking about 8% here in this portfolio. And the reason for that is because we have the GDA generating cash, and that is a fixed income investment. So if you look at our pension trust as a whole, we're closer to 45% fixed income. And we're only talking about 8% here. And the reason for that is because if you think of our pension obligations, we have two categories. One is the guaranteed pensions that are guaranteed by Empower, that is backed by the GDA. And then the non-guaranteed pensions, so anybody who started collecting their pension after 2016 is a non-guaranteed. Now, it's still guaranteed by us, but it is not guaranteed by Empower. And so that's what we have to fund going forward, are these non-guaranteed pensions. So if you look in your packet, I put a slide in about what our holdings are, both in Empower and what our non-guaranteed pension payments are per month. So it's this, it was in the packet. I didn't print it out for you guys, but it was in the packet. But basically, we had a year ago, so in December of 2024, we had about $117 million in our GDA, that's the guaranteed deposit account. Our minimum fund liability, or MIFL as you've heard it referred to, was only about $112 million. So that means our liabilities for pension payments was $112, we had $117 in cash. Okay, so we were well funded there for the pensions. That has come down over the course of 2025, so that at the end of, call it November, before we put money in November, our minimum fund liability was $106 million, and we only had about $107 million in cash. So again, we've drawn down that money. We replenished that money at the end of December. We put about $2.5 million into Empower, into the GDA. So again, we're well covered there. But the other chart that I put on that sheet was our non-guaranteed pension payments per month. So in December of 2024, so a year ago, we had to pay $593,000 every month in non-guaranteed pensions. By the end of December of 2025, that number was almost $700,000 a month. So we saw a little over $100,000 a month extra get added to our obligation. And then if you look at what I printed out for you, this chart, okay? So this is our forecasted monthly non-guaranteed. So you see here at the end of 2024, our monthly obligation was $593,000. At the end of 2025, it was $698,000. And we're projecting that by the end of 2026, it's going to be $810,000 a month. And you see the increase every year as more and more people retire. And that is the other sheet of paper I gave you, which is our expected retirements. Over the next 5 years, or 6 years rather, we're going to see 58 retirements, pension retirements, which is about 24% of our overall workforce. And so that large number of retirees over the next 5 to 6 years is what's going to drive this need for cash flow. So we now need to start thinking forward, how are we going to meet these monthly obligations to these new pensioners? And so that's what's leading into the discussion of our asset allocation. And so we decided not to put more money into real estate. We didn't think that that was the best investment. We are underweight alternatives. We're currently a target allocation of 5%. We're only at 2%. So we are looking at one more private equity fund to add to the portfolio. So we're going to stay right around that 5%, about $5 million to $6 million allocated to private equity. Real estate, we're going to kind of just keep where it's at. And so it's currently about 6% of the portfolio. We do have the ability to pull money out of principal if we needed to trim that back a little bit. As I said, that's going to take 6 months to get money out from them. And we have about, if you look on page 8, we have 2.4 million invested in principal. we could pull that back and make that request. TerraCap, we can't pull money out, that's totally illiquid until until they start making distributions. So going forward, Brian, what was your recommendation to how to reallocate the portfolio?
It was trimming 4% out of real estate, which is effectively taking it from a 10% target down to its existing exposure at 6%.
Right.
And then the other 4% comes just from trimming US equities and international equities.
Right, so we're gonna move the target back for domestic equity to, currently the target allocation is 35%. We were gonna move that to 33 or 34? 33. And then we were gonna move international also by 2%, right?
Correct.
So we're gonna take that from 25 to 23. And then fixed income, which we currently have a 0 target on, we're gonna make that target 8%, right?
Correct. And the math on that 8% is because it's what we expect to spend. It's the net cash flow need on an annual basis.
Right, so, and that's gonna be, a combination of a intermediate term, bond fund and a short-term bond fund, right? So we've been using the Baird funds. So right now, we've got, $2.8 million in the ultra-short bond fund, and we're gonna allocate, about $6 million to the, intermediate bond fund, and we'll keep that replenished so that we're gonna have to make monthly, quarterly out of this portfolio over to Empower so that they can pay the pensions. Okay, so I'm trying to get it to be quarterly so we don't have to make monthly payments, but I'm working that out with them. So it'll either be monthly at about $700,000 a month, $800,000 a month, or it'll be 2.1 to 2.4 a quarter. And so we'll constantly be replenishing out of the, into the fixed income to make sure that we're not gonna run into any market timing issues to be able to meet that obligation.
Right, couple comments around that. One, we just talked about how this worked perfectly and it's 9%, and that's what the purpose of this was. So, you know, now we're moving this target to be a little bit more conservative, so I would adjust our 7% expectation over time, right? Wherever it was, it's gonna be less because we're adding the bonds. Two, we just talked about how real estate's opportunistic and we're gonna reduce it. Not a fan of that, right? So this is the time to be purchasing because the asset class is rotating back into having an opportunity to potentially do better if rates are coming down. We don't know what the future's gonna be. And this is probably a no, but why, so the key of not wanting to be a forced seller ever, right? But we have all this cash. Can we use cash that we have sitting in money market until the market is right to sell and replenish it? So if we're sitting on all this money at the township and we needed some money and the market happened to be off, so leave it fully invested and then sell 6 months later or even a year later when it's back to a right number from a timing and forced selling.
Yeah, so that's a fair question. It's really two separate and distinct entities, the pension
Okay.
trust versus the township fund. So if we put township funds into the pension trust, which we do every year through our ADC, our required annual contribution, once it goes into the trust, it can't come out.
Okay,
So we can't loan township money or use township money because that's all, you know, it's dedicated to various township requirements, you know,
Okay.
water and sewer and public safety and roads and, you know, all those
Got it.
things that are for township stuff. So that's really two distinct and separate entities.
can't cross the line. Okay,
Can't
I
cross the
figured
line,
that. Okay.
yeah. So, but, I
So we're
mean,
kind
you're-
of forced into this.
yeah, so your point is well taken about the real estate. We could certainly address that. I'm not suggesting that we pull money back. We're just lowering the target from 10% to 6%, which is where it's currently at. Principal and Bloomfield Capital are continuing to invest. It's just TerraCap that we're locked into those properties that were bought in 2021. So we could keep those, and I like the fact that they do generate cash.
Yeah, I'm not even critiquing
Yeah.
TerraCap.
Yeah.
That happens from time to time.
Yeah.
Timing's the issue. At least we don't own a coffee bean farm, right?
Yeah.
Exactly.
So,
Yeah. Or not own a coffee bean
Yeah,
farm anymore.
right. So I get it. Okay, I just wanted to make sure that we adjusted our expectations as
Sure.
well as we
Sure, yeah.
shift to a cash.
Yeah, absolutely
Cash
right.
flow out a little bit more often.
Yeah.
I have a follow-up question to yours. Since we do have an actuarially determined contribution, can we time that to offset various cash needs? And is that something we can consider? Because we have to put the money in anyways.
Yeah, no, you're right. I mean, we could certainly make a monthly contribution versus right now we just make it all in December. But, I mean, that's certainly, Jason, I don't know if you've,
But that contribution's not enough to offset what we have to draw.
no,
So-
no.
Not all of it, but like you said, of timing of events.
Yeah.
It's over 6 million. So that's a lot of money, especially if there's an opportunity to improve the end result.
Yeah. I don't know, Jason, you have thoughts?
I mean, in a way, we've been doing that each November, December. We have a conversation of, there's $5.5 million we have to pay out for the ADC, and we assess where should that go and which bucket, and if you have a MIFL requirement, we haven't had that in a while, but the years where we did, since you're infusing $5.5 million of new cash into the trust, that then, when you do that, actually counts as your MIFL requirement as well. So, in a way, to both your comments, we've been doing that. The only new thing you could assess is, instead of doing one contribution throughout the year, you could try and time it and do a multiple. But in the end, you're still gonna need to get to that $5 million number, and you can evaluate what time you wanna do it and which portfolio and assets do you wanna put it into.
But for the pension, that usually goes in January, correct?
Pension is typically end of November, early December.
Okay.
Because it's on a calendar, the plan year is a calendar,
Year.
so it just has to be done by
Versus the,
12/31.
Township
So
financial.
typically after 4/1, so because it has to be in our new budget year, and then by 12/31 to make it into the plan year.
Right, so conceivably, once we get to April, and we start our new fiscal year, we could take our 5.67 whatever million dollar ADC and start making it monthly over the course of the fiscal year. Just do it. It has to be done before December,
The full payment.
the full payment, right? So, so I guess we wouldn't divide it by 12. We could divide it by 9 theoretically. We could do that. You know.
So what I'm hearing is we just need to be more intentional about how this is, before we just kind of let it ride.
Yeah.
Now we're on instead of accumulation, we're on a harder distribution or decumulation of some sort, and then we need to be more intentional.
And I will tell you, that's where our conversations have shifted from periodic throughout the quarter to on a much more regular basis. Just checking in, where are we on cash flow? Has Empower, giving you any update? And I would say also understand that this plan is fluid and changing because of this, right? So the 8% we have today could be 10%, constantly looking at cash flow to understand, because they're a must pay, not want to pay, right? Unlike a foundation where if the equity markets are down, well, I'm sorry, we're just gonna give fewer grants this year. This is a benefit promise guaranteed to be paid each month. And if I'm supposed to make a deposit of $4,000, into your bank account, and I make a deposit of $3,999.99, a township phone line's blowing up, right? So it's constantly monitoring and making sure that we're aware of future cash flow needs, because we don't want to be surprised.
I have one other question regarding the cash outflows. Does this include Empower as well?
No, this is just the non-guaranteed pensions. The Empower, the guaranteed pensions are funded out of the GDA.
And what if, you'd mentioned earlier, on occasion, we have to put more money into the GDA?
Yeah, so the reason the GDA has been declining is because we've been using the GDA to fund this. Now we've reached a point in the number of non-guaranteed pensions that it's too much for the GDA to cover. basically. So we need to start covering this portion. But the way the GDA works is when it makes a benefit payment to a guaranteed pension, it reduces the MIFL, at the same. So it stays funded. But we've been using the GDA to fund these, which don't lower the MIFL. And so we need to start, funding these because the number of non-guaranteed pensions has increased, so.
I'm going to continue.
And then
And
what's,
it's gonna continue, right, over the next 5-6 years, yeah.
so based on that, we won't have to be putting any more additional funds into the GDA?
Correct.
So
I mean,
that-
the only way we'd have to put more money into the GDA is if interest rates fall below 1% again.
okay.
Because the GDA is designed to match the liability, the MIFL. But if the GDA isn't earning enough to cover the increases in the MIFL, then we have to put money in. So when interest rates were below 1% for several years, we had to keep putting money in for the GDA to keep up with the increase in the liability. Lately, the interest rates have been high, so the GDA has been earning between 3% and 4%, so it's earning more than enough money to cover the guaranteed pensions.
And will we continue to pull money out, a portion of that out of the GDA moving forward, or no?
Well, the GDA will always fund the guaranteed pensions.
If there's additional funds in the GDA because of higher interest rates, will we be pulling those out?
We could, it could, if it's generating a higher interest rate, we could lower our contribution and use some of that money to cover these monthly payments. But, right now it's earning 3%, so there is a little bit of extra money there.
But it's not worth it to make the move at this time?
Right, so we wouldn't, so like right now, our monthly pension payments are $700,000, okay? So maybe we only need to put $500,000 in out of the equity portfolio because we can take $200,000 out of the GDA, right? As interest rates fall, we're not gonna have enough money in the GDA, we're gonna have to start funding these full payments.
And because of the expected cash flows from the non-guaranteed pensions, it's probably more beneficial to keep a little extra funds in the GDA so we don't have to come
Yeah,
up with more
well,
cash.
Empower requires us to have 6 months deposited with them of these payments.
Okay,
So I'm trying to get them to lower that if we make monthly payments, but there's no guarantee they're gonna agree to that. But right now, we have to have 6 months on deposit with them. So right now, it's $700,000, so we have to have 6 months of that on deposit in the GDA for them to make these payments. And then we just have to fund it each month to keep that 6 months intact. Again, I'm trying to get them to lower that if we start to make monthly payments. I haven't gotten an answer from them yet, but instead of 6 months, I asked to take it down to 3 months if we're making monthly payments, but.
If it helps. So the choice a year ago, right? Empower's always happy, like, hey, you need to fund another $700,000. You can take it out of our portfolio, which we really don't want you to do because we earn a fee on that, or you can pay it from your equity portfolio. And we made the choice of spending down about a $7 million surplus over the last year that was earning we can take this $7 million that's earning 3.5% here,
agreed,
or keep it here and made 16% on
agreed.
it.
It's a no-brainer,
Yeah.
yeah. And, yeah, understood.
Yeah, okay.
And then is our goal to sell down total equities and then domestic equity to fund the total fixed income as well as our increase for private equity? Is that the current plan right now?
That would be, yes, we would trim back domestic and international equity and use that to fund a fixed income allocation.
I have one other question regarding the payments, and that's the pension bond. Pension bond payments are $5 million. Those are retired in May of 2033. So really, the concern is, right now, the bulk of this concern is up to 2033 because we'll have that additional cash flow in 2034.
Right, so the pension bonds are general obligation bonds of the township. So when we pay that totally separate from anything we have to pay to the pension trust.
Correct.
We borrowed the money to fund this so that we could have this portfolio return 9% when we borrowed the money at 2 to 3%.
Correct.
So When those pension bonds are up, that frees up cash flow for general township purposes. It doesn't affect this in any way.
But this is a general township purpose, so that can be used to fund.
Sure, theoretically, we
Theoretically.
could take that money and put it in here and leave the money in the equities. We could always overfund the pension.
Well,
You could.
eventually, according to the Milliman actuary, you just have to start drawing it down. So, having too much money in there when the expected drawdown is coming wouldn't make sense.
Right, no, agreed. Okay, are there any other questions on that? The other topic I just want to address, and it's actually lower under new business, but since we're talking about it now, we're talking about cash flow, is this concept of pension buyouts. I was able to negotiate language into all of the collective bargaining agreements that allow us to offer pension buyouts to retirees when they retire. We cannot offer it to somebody who's an active employee. It can only be at retirement. And as of now, the legal answer I'm getting is that we can't offer it to existing retirees because there's an IRS issue there. So basically, this option to take a buyout would have to be at retirement, before they start collecting, but when they've terminated their employment. And so I just want to address cash flow because, these pension buyouts are going to be roughly, $1 to $2 million each. I have received some interest from a few employees about it. And we're just fine tuning how we're going to actually calculate it. But I guess what I'm asking for from this committee is how aggressively do we want to be pursuing these? Because we're going to have to pay for that out of the trust that's going to come out of these funds, out of the equities funds, to pay that buyout. I see it as a benefit. I will only do it if it's accretive to the plan. We're not in any way going to take a loss, but we're going to reduce the liability and reduce cash.
And reduce our long-term costs.
And, right, the liability, the long-term cost. And it basically de-risks the plan because we don't know where lifespan is going. I just saw, a headline a couple weeks ago about, the raising life expectancy rates. And so people are living longer. We have a dozen people on our pension that are over the age of 95. And when they retired 40 years ago, there was no calculation that said they're going to still be collecting a pension in 40 years. So it wasn't properly funded, which is no fault of the people at that time, but it's just, life is,
You're blessed.
medical has changed, right? So by buying out these pensions today, we eliminate the long-term risk that they're going to outlive what we're allocating for them.
So, Michael, when you say be more aggressive, kind of give us a definition of that.
So I could be more aggressive in terms of marketing to these people that are going to be retiring over the next 5 to 6 years and try to convince them to take a buyout versus just throwing it out there and say, anyone who's interested in a buyout, come see me. And, it'll be a trickle, 2, 3, 4, whatever, versus, hey, do I want to be out there trying to sell this?
Right. And
That's what I mean by
And
aggressive.
also mention that they get lifetime health care that we're paying too, right?
Correct, which is, yes, they
Which is another big
would
additional
have
cost,
lifetime
only
health
going
care,
up.
which is separate from this.
Right, which is only going up as well.
But if you offer, or we are offering the pension buyout, is there a limited number? Like I know with my husband's company, they could only offer a certain percent buyout because they didn't have the money. Would we cap that? Would we limit it?
Well, we have the money, and we would have to buy it out right around what the actuarial value of their pension is. So we would look at, so let's say you take a police officer who comes in, they're earning $95,000, they cap out at 80% of their pay is they're going to be their pension, right? So
For
you
their
look,
3 best years.
right, so the 3 best years, so let's say, 80% would take them down to $72,000 is going to be their pension plus the 1% every year. We would run a calculation that says, okay, we think you're going to live 20 years and this is how much we're gonna pay, and so we'll give you that payment today, basically. And the benefit of doing that is if they live longer than we project and they're still collecting a pension, we have to pay that pension. You know, and versus if we buy it out today, they could live, you know, God bless, live as long as you can, but we're off the hook.
Is the buyout considered could it be considered part of the actuarially determined contribution?
I don't know, that's a great question.
It's
It would
that's
just
going the-
lower it.
It's going the other way.
Yeah.
Yeah, I mean, by reducing the liability, it would reduce our ADC. But but I think Mark's question is, can we count the 2 million that we're paying as a buyout towards our ADC? No?
I'd say no, but it's gonna adjust the formula, right? So it could.
They run the actuarial ADC annually. So, you know, let's say 2 people took a buyout, they would come out of the pool of people.
But the cash flow's moving out of the plan.
Correct, but it doesn't count toward your ADC.
It does not count, it's not considered a contribution?
Correct.
So,
It just comes out of the formulas that they use.
Well, okay, but I think what Mark is saying is, if we have to put 5 million into the plan, and then the plan immediately has to pay 2 million out to a retiree that we're buying out, I mean, essentially, we could take 2 million of that 5 million and just give it to the retiree, and that would count as part of our, so I think, yes, it would count as part of our ADC payment, but it wouldn't change,
annual
it wouldn't change, the change to the ADC would be very minimal, because we're only removing one person from the calculation, so our liability is, you know, gonna be shifted down a little bit, but,
I'm more looking at on an annual basis, if you're going to put a restriction on how many people you're gonna buy out, that
Right.
might be a way to do it, if we can count.
yeah, I mean,
the-
that's certainly an option, but, I mean, I'm open, you know, to hear other people's thoughts on this, you know, to take money out of, whether we take it out of the ADC, either way, it's money that's coming out of the equities trust.
But will it be reducing our long-term costs
It will be reducing,
considerably,
yes, it
right?
will.
And you can run some numbers on that for us.
Well, that's what the actuary does, they'll tell us that, you know,
And you've interviewed a couple of people that inquired about doing this.
I mean, I haven't really interviewed them. They've come to me and said, hey, we saw the language in the contract that you're doing buyouts. We're interested. Can you tell us more about it? And I said, well, I don't have all the information yet. I had to figure out, you know, where the money goes when we pay it to them. We can basically, we'd open a 401A account for them and then transfer it. It's like a rollover, okay? And then they could draw from that and they pay taxes as they draw money out. So that was one question. And then the other question, and of course, this is going to be their biggest question, is how much am I going to get? And I'm still working that out with the actuaries at Milliman to figure out how we're going to calculate that, what are the assumptions that are going to go into the calculation, et cetera. But I would only do it if it lowers our liability by more than we're paying out in cash.
Right.
As long as it continues with that assumption that it's gonna lower liability, then I'm certainly in favor of it, you know, as I was when you first presented it to us. I had the same question as Mike, what do you mean by aggressive? And I think you've explained that. But I would, you know, I would recommend that once you have more information, you provide it to the employees and say, rather than say, if you're interested, come and see me. Here's the information that we currently have.
Yeah.
Here are the assumptions, and why don't you come see me if you're interested? But at least give them as much information as you have at the time.
Yeah,
Are our pensions single life or joint life?
joint meeting with.
Can they pick?
Yeah. they
Yes.
can, yeah.
So
they-
you really kind of, this could go on for a long time.
So,
at
yes, so
some
they
reduced
can,
rate.
when they retire, they have the option of choosing
Survivor.
a survivor of their spouse to continue their pension after they pass. It's at a lower amount. Well, no, you could get 100%, you can get 2/3, or you can get 50%.
There's a formula.
Right, yeah. And then, so obviously, if you do that, it lowers your payment, it lowers your pension amount, but yes, it could continue long after the,
Yeah, I think it makes sense to look at that, because the quicker you can get this done, then it's one less administrative obligation as well. Right?
So one thing that I've seen other communities do is, as you get closer to retirement, you will meet with HR or meet with the people to understand the numbers. So here is your packet. This officer, you're gonna get a $71,000 a year pension. Option B is, we will buy you out at 1.2 million. Here are your assumptions, here is how it would go. Hand them both pieces of paper. Then, not only are we educating our members, every single one of these people that are retiring, we're giving them the option. So I wouldn't call it aggressive, I am informing our
Maybe
employees.
aggressive was the wrong word, I just meant like, how much do I want to push it versus just wait? Like, do we want to only do a couple of these for the people that actually seek it out? Or do I want to, like you said, give a piece of paper to every retiree that comes in and to try to say, hey, look, this could be good for you?
If it's contractual, you gotta do
If
it.
it's contractual,
What's contractual, the contract just says that we are allowed to.
allowed to, it's not
It
shall
doesn't
or
in
may.
any, and there's no shall, like, we are not required to. We are not required to do any buyouts. We could say, hey, we're not gonna do it. But it's, the language in the contract allows us to do it.
So I think it is a major benefit not only to the township for reducing our liabilities, especially if we know that it can reduce our cash obligations, but from an employee perspective, I can control my own destiny, right? So a pension is not inheritable wealth. So if I am able to provide them with a $1.5 million, that is wealth they can pass on to different generations versus a pension stops upon the less beneficiary getting it. So I just think by providing them both pieces of paper, not only are we informing our members, we are also helping the pension plan. So that's how I would like to see it. And again, in other communities, that's what they do.
Okay.
They provide both.
Okay.
I think that makes a lot of sense.
Any other thoughts?
Michael, I would just, I guess, only area I would be concerned or cautious about, and you've probably thought about it, is the cash flow. We talked about the drawdowns, and so with each buyout, you reduce liability, but you also reduce the assets in the plan because you're paying it out of the asset. So if you just compare it to making a monthly payment over 40 years to a pensioner at much smaller versus now you've taken 1.2 million out of the invested assets that earning it over their lifetime and earnings on it while you're paying it versus a big lump sum if you have multiple in a year. Is that,
Yeah,
you know,
I mean,
it's-
that's absolutely right. So, we're earning, call it 9%, let's say we add the fixed income, that it goes down to 7% a year, versus, a huge chunk that we're paying out today. And because of the GDA and the Empower contract, we're locked into that, right? I mean, and those guaranteed pensions are gonna be there until the last one is collected, gets collected, which is probably 25 years from now. And so, whereas these will go a lot longer, right? Because these are younger people that are starting their retirements now. They're retiring at 52. We just had a guy in the pension that just died at 105. So, and that was a firefighter, which, they always say that their life expectancy is shorter, but that guy lived to 105, so good for him.
But we're 10% underfunded, so you could fund the other 10%.
We
So
could, yes.
try a little bit of this if we had to fund
Yeah.
to get to.
I mean, the ADC that we have to make includes an amortization of that 10%, so that, I believe, Jason, correct me if I'm wrong, that it's by 2038. Our ADCs should get us to be fully funded. But we could certainly, if the township's cash flow allowed it, we could certainly move that up.
And try a couple of these.
Yeah.
And see how it works.
Yeah, we could certainly. move
Without
that.
disrupting this.
Yes, we could certainly do that, so.
And again, if every single person took it that was eligible or likely to retire in the next 5 years, that's 58 people. Again, I don't think all of them are gonna. So even if you got 10% of them, we're talking about 6 people over the next 5 years.
Right. Right.
Michael, are you thinking it would be an all or nothing, or, for example, when my husband did it, they offered 10% cash max. It was an option, but it was either 100% pension or 90% pension, 10% cash out.
This would be 100% cash out.
Okay,
No,
because that's
there-
another way to make it go further. if
Yeah,
it
but that's much
became
more
popular.
complicated from an actuarial standpoint, and doesn't really,
Get rid of it.
yeah,
Correct.
so, yeah. Okay, I think we
Good subject.
discussed that. Let's move on to the Retired Employees Healthcare Benefits Trust. Brian will walk us through the portfolio there, and that begins on page 9.
So, completely different cash flow situation for retired healthcare trusts. Any forecast that we have, says we have no expected needs for the next 15 to 20 years, and we limited it to 15 to 20 years is because we don't look out 25 years. So with the Retiree Healthcare Trust and its underfunded status, and the long-term plan is allow it to grow, allow it to grow, allow it to grow, it's really in a position of being as aggressive as we are legally permitted to do. So max we can have in equities is 70%. We have 70% in equities. The maximum we can have in private equity is 15%. We're pushing towards 15%. The idea being is with no cash flow obligations expected out of this portfolio for the next 2 decades, allow it to be in the parts of the market that over the long run will deliver the absolute best returns. So that's where you see there is a little bit of fixed income in here just because as you check each box from a maximum exposure under Public Act 314, which is the state law that governs what we can do on the pension and retiree healthcare side from an investment standpoint, as we hit each of those maximums for equities or private equity or real estate, as you add those up, you can't get to 100. So you have to have a small portion in fixed income, but we keep that as minimal as possible, and then that's used as a funding mechanism for when we have capital calls for private equity managers. But, as an example, last year, or so far this fiscal year, Retiree Healthcare Trust is up 14, almost 15%. That number would be north of 15% today versus a 7% assumed growth rate. So just continued good news. Managers are the same, it's just the asset allocation is a little different. That's the extent of prepared comments on retiree healthcare, but I'm happy to answer questions.
Why don't you, if we don't have any questions on that, why don't you talk about the asset allocation?
Yep. So this is page 10, and you can see things really reflective. So, in line from a domestic equity and international equity standpoint, because our max exposure, each of those is 70%. So we have the good problem of continually having to trim those back a little bit because they've keep going above the 70% limitation. You'll see we are a little bit overweight in domestic fixed income just because we are underweight in real estate here and we are underweight in alternative investments, but are actively working on either there's money being deployed, for example, in Capital Dynamics or in Bloomfield Capital for the real estate portion, and then actively looking at new investment opportunities to add to the portfolio as it grows and can scale to bring down that domestic fixed income. So please understand that is not a market call of being overweight fixed income. That is the reality of we've made commitments to Capital Dynamics that have yet to be deployed. And because we cannot have more than 70% in stocks, that money has to be somewhere else from an investment standpoint.
I have a question about the asset allocation. Our business inspection fund is generated from fees. And I think it's about 170 to 200% fully funded. So why would we place that cash and that sub-account into an equity fund when it can be self-sufficient?
So you're conflating two issues. So the building inspection fund is a governmental fund, part of the township. So that's addressed earlier with the operating funds, all in fixed income. We can only be in fixed income. This is strictly retiree healthcare. This has nothing to do with building inspection.
So this is separate from OPEB.
This is OPEB.
Retirement healthcare.
Yes, so in OPEB, for the OPEB liabilities.
Oh, I understand what you're
For
saying.
business inspection are 170 to 200%. It's a sub-account. We don't look at the sub-accounts during the meeting.
Right,
We discussed asset allocation.
right.
And if you're generating 3 to 4% on fixed income and you're 170 to 200% funded, why would you put that cash into equities when it's already self-sufficient? You have enough assets.
Right, so the funded status of the trust as a whole or any of the individual sub-accounts can move around. And based on what's going on in the market and what the liabilities are, et cetera. So the strategy for the retiree healthcare OPEB trust has always been fund as much as we can into the trust and put it to work as aggressively as possible so it can grow over time so that in the future, we can take that money to pay the benefits. Right now, we're paying the benefits out of our operating budget.
Cash flow.
Our operating cash flow is how we're making the current payments to the retarees.
You're looking at the fund as a whole. I'm looking at a sub-account, and we have a sub-account that's fully funded. We charge fees to residents to inspect buildings and properties. It's not tax-based, it's an enterprise fund. It says it on the reports. And it doesn't make sense to me when we can generate 8% or 3 to 4% on a fixed income for that section of the portfolio and have it be fully funded and help lower rates for inspection fees, because it would drop that requirement. I mean, we shouldn't be, building inspection shouldn't be putting money in if it's fully funded. And that's what I'm trying to understand.
Right. I guess my response would be that would be a better topic of conversation at our budget meeting, when we address how we allocate the revenues and expenses as it relates to that fund. What we're looking at today is simply how we're investing the portfolio for the OPEB trust. And so I think it'd be better if we address that in 2 weeks.
But that's the whole crux,
But
is if you're 200% funded.
I understand,
on a
but,
fixed income.
but the trust as a whole is only 29% funded.
Right.
And so we're not putting, we're not taking any money out of that trust because we want it to grow as aggressively as we can so that in the future, it can make those benefit payments. But right now, the benefit payments are paid out of the operating budget. And so what we're looking at today is the portfolio as a whole with our investment advisor. Again, I would suggest that the topic of reallocating for the individual sub-accounts or funds is a topic that should be addressed at the budget meeting.
Right. And we are out of state oversight now for our OPEB.
So Brian, the funding policy and strategy, if you could just clarify, is for the whole trust as a whole. You don't look at or allocate based on the sub-accounts that is being referenced, correct?
Correct. The investment strategy is for the retiree healthcare OPEB trust in its entirety, not on an individual sub-account basis. And you recall, from an investment standpoint, those assets were consolidated in April of last year after we were done with fiscal year end, because it allowed for greater efficiency, lower costs, access to investment opportunities that we wouldn't have if we're trying to parse out on an individual sub-trust by trust basis. But an important distinction, it was combined for investment purposes, but it is tracked and allocated for accounting purposes separately so that we can identify each of the sub-accounts, whether it's police, fire, water, cable, building inspection, each of those are tracked individually. And, for example, are laid out in the actuarial valuation each year.
Would your recommendation on the investment portfolio makeup change if a fund was 29% funded versus 200% funded?
Yes.
Yeah, so that's the crux of it, because we decided to put more cash in from water and sewer, cable studio, and building inspection. Those are all fully funded. The places that aren't fully funded is something else, and that's one of my concerns is, are we creating taxes by how we're funding this? And that would be an additional liability to the township.
I'd say my caveat would be, at the end of the day, I need to earn a long-term rate of return. And if it's 200% funded and if I'm assuming I'm gonna earn 6 or 7%, that 200% funded status is assuming I earn 6 or 7% over the life of all of the participants that are in it or are going to come in it. And that 30% funded status is assuming a 6 or 7% growth rate over the life of all of those participants. So the asset allocation solves a math problem of what's my mix of assets to get to a 7% return? Because I could make that 200% funded at 7% return 100% funded if I then said we're gonna make it a 3% return. Like, the actuary can move whatever lever they want, but I'm solving for 7% from like, my math problem that I'm solving for is what mix of assets gets me to 7%? Because whether I'm 30% funded, 100% funded, or 200% funded, that's what the actuary is assuming over the next 20, 30, 40 years we're gonna earn. We have well-funded plans. Look, I've got an OPEB plan that I'm gonna see tomorrow morning that's 150% funded. That's gotta earn 7.25%. The difference is they have more exposure to managers that typically do better in negative markets because we're trying to protect, but they still have to earn and still have to take risk in the stock market to pay out those benefits over the next 40, 50 plus years.
And my concern is we charge fees for water and sewer. Using those fees to meet obligations of the general fund would be inappropriate. Same with business building inspection, we charge fees, it's not tax-based. Cable Studio is now collecting fees to help cover their budget. So, again, I don't want the township to be in a position where it could be shown that these fees are actually being used to meet tax obligation requirement. That's, doesn't have to do with what you're doing, but it is something that the township board has to consider.
And I'm not disagreeing with you, Mark, but let's deal with it at the budget meeting.
So just to also be clear, there is no money from those funds being used in the general fund. There is the water and sewer fund and the cable fund. They're separate funds. And those are not being diverted for any general fund purpose at all, period. You have a concern, hypothetical concern, we would all agree that money shouldn't be used from the water and sewer fund to fund general expenses. Absolutely, period. You're right. But the answer is they're not.
Actually, there's a form Jason fills out that we sent to the Department of Treasury, and it includes the actuarially determined calculation of all 5 separate funds. The fund contributions required from Cable Studio, building inspection, and water and sewer are all negative. That results in a drop in the actuarial determined contribution for the fund as a whole, reducing the obligations for the general fund and public safety. So mathematically, it still works out separately. And we're not going back and saying the fully funded portions don't have to put anything in. We're putting in more money. Even last year, we put in $50,000 above the benefit payouts from water and sewer, yet the board never approved that transfer during a board meeting. So I think it is a serious thing, and I think it puts the
Every
township at
transfer
risk.
has been approved. So
So-
moving on from that,
so-
the other important point I want to make is that making the contributions, I think, are important, even though it may be, as an individual fund, overfunded. Over my life, I've seen, in giving advice to employers, they can be overfunded one day and completely underfunded the next day. I don't know what the market's going to do. And so a wise employer doesn't just run around at 100%. They make sure they're continually making investments, because the actuarial numbers will change a lot depending on how the investments and the markets go. And someone who thinks they're doing really great because they're 100% today and could be, at 50% tomorrow, and then they're in deep doo-doo. So it's a conservative way to continue to fund these obligations. It'd be risky in my mind to stop, to lower our returns or to stop making contributions because the actuarial number looks good at any given day. And employers that did that over my career and watched them do it suffered later, measurably so, because they had greatly increased the contributions to catch up. So that's where I think why we should do it.
I want to be mindful of everybody's time here. We can certainly address these topics at the budget meeting. But as it relates to this portfolio, the asset allocation, Brian, do you want to address the changes that we're recommending for this portfolio?
So on the retiree healthcare side, it's really trimming the fixed income allocation from 15% down to 7.5%. Increasing the alternative investments from 10% up to 15%. Revising real estate from 10% down to 7.5%, which is really reflective of our current exposure.
Yeah, and without any changes to the equities.
Correct, because we're at our ceiling. Our target is our ceiling. So that's a continual monitoring to make sure that we stay in compliance.
Right.
And again, it's reflective of the projected cash flow needs or lack of cash flow needs for the retiree healthcare trust. So let's put it into maximum growth mode to close the gap from a funding standpoint.
Okay. So those changes will be reflected in a revised investment policy that'll come to the board on Monday. And same thing with the recommended changes to the pension trust equities allocation. So wanted to discuss that today so that the board would be aware of it when we address it on Monday. Okay. At this point, that concludes the retiree healthcare review. And now I'd like to move on to the defined contribution plans. And as the board knows, we don't invest this money. I call it participant-directed investment accounts. We have the 401A retirement plan that the township puts money in for active employees, and the deferred compensation 457B plan, and the retirement health savings plan. All told, it's about $73 million of participant money. They direct how that fund gets how those funds get invested. And we have Rob Higgins from Schwartz and Company, who is our investment advisor on these funds. And as Rob will tell you, he also meets directly and individually with the employees to help them choose which funds they want to invest in. So I'll let you, Rob.
All right, we only have 78 pages to get through, so it's gonna strap it up. I'm gonna pick select slides, of course, honor your time. I appreciate being able to present to you today, though. I'm gonna dive right inside of tab 2 on page 10. These are some select slides pulled from a plan health update that Empower provides to us. I'm happy to follow up with the complete reports for both the 401A, 457. This particular slide pertains to the 457 plan. Of course, the 401A, heavily funded by the township. 457 is the optional component, and that's probably a more meaningful metric in terms of impact we're making as advisors in terms of encouraging people to contribute to their own retirement. So there's some stats and figures. Again, I'm not going to spend time on every number you see here. I did want to show on page 11, I highlighted the average balance in this plan, healthy, and it's a growing trend. We'd like to see that. On page 12, I wanted to call out somewhat of a statistical anomaly. If you will follow me to the far right column under 12/31/2025 data, third row down, reflects the average contribution rate. You'll see 5.6%. Everyone see that? And if you compare that to the prior year, 11.6, you're like, geez, what happened? And I had that reaction myself, and I spoke with my contact at Empower, and it comes down to a quality of data issue. So, for instance, in 2024, Empower had 13% of salary information on file. So they were making their average deferral percentage based on 13% of actual data they had for people's salary. This year, Elizabeth's been hard at work, so that payroll data is better, more higher quality. 70% of actual data or actual salaries are on file now, so we can make a more statistically accurate projection there. So we'll continue to shore that up. That's a follow-up item I have, an initiative, maybe have to lean a little bit more on Elizabeth just to get that file uploaded. But at any rate, I wanted to explain that away if that caught your eye. I will leave the rest of those slides for your review. I do want to show you on page 19 and 20, Powers spent a lot of resources, plow back internally to add more depth to their education program. And it's very dynamic, I would say. There's a number of touch points they have throughout the year. And so this is, I think what they're doing serves as a great complement to the work that Schwartz and Company is doing on an individual basis. And sometimes people need to hear messaging a few different ways. And Empower does that in a variety of ways at milestone moments throughout the year. And they do so in a more customized way based on the individual, so it's not just stamped out. So I wanted to point that out. And of course, that pertains to both plans, 401A, 457. On page 21, I did provide you with a recap of specific education that took place from Schwartz and Company. And this is something, obviously, I pay close attention to. So I was happy to report we had 79 qualified investment consultations. That's a sticky number. Those are meetings primarily held with me individually. And whether that's over the phone, Zoom, at Schwartz & Co., or here on site. I enjoy that. That's probably my favorite part of the job, is meeting with people, and we'll continue to offer that and make sure that's available on a going forward basis. In addition to those individual consultations, those opportunities, we also did 2 different on-site education, group education meetings, April and then in October. So we had a lot of face time with individuals last year, and that's always a good thing to keep turning that wheel. What's not reflected here are 2 on-camera Q&A sessions I did with Michael at the cable. On cable, that was probably my favorite. I probably should have highlighted that. But that was all in an effort when we did a lot of work behind the scenes last year in implementing a new target date series, which the important feature there was these target date funds happen to include an income for life component. So they're relatively new concept industry-wide. Hands down, Bloomfield Township is leading the charge in terms of being out in front of that. Not many plans have adopted that feature, but it is something being talked about because, as Brian mentioned, everyone's used to getting a paycheck, and then when retirement hits, they're no longer getting a paycheck. And so how do you take your big basket of savings and understand how that's going to cover 30 years of your life going forward? So income for life is becoming more and more important for people to continue getting, quote unquote, a paycheck into retirement. And so, Jason, Michael did a fantastic job kind of leading those discussions, and we worked a lot to identify a solution there and provide people with an option, meaningful option. So in that effort, again, Michael, Jason did a fantastic job of making sure that there are plenty of opportunities for people to make informed choices and really understand what was being added to the plan. So kudos to you guys for taking the time in that regard. And it did allow me to be on camera with Michael, so I appreciate that. More to come, right?
Yeah.
I think you're going to look for a series. Okay. skipping ahead to page 25, I wanted to show you a roll-up of the 457 401A plans, combined asset update. I highlighted in the lower right, 64 million in those two plans. I also highlighted in the middle there the largest, most highly concentrated position in the JP Morgan large cap, 22% of plan assets. That fund continues to do well performance-wise, so no issues. Always worth noting where the highest concentration is within a fund lineup. Behind that page, I have the individual 457 401A assets split for you. Let me draw your attention to page 28. Couple notes here. First and foremost, the effort here is to provide you with a weighted average. Hey, what's the all-in cost on average for a participant in the Bloomfield Township 401A 457? So left to right, we've got the funds, assets, and then expense ratio of each funds, and then on a weighted average basis, plan costs. And down at the lower corner there, you know, there's three cost components. It's the weighted average investment cost, advisor fee, and then the record-keeping fee. And the sum of those parts, 57 basis points, 0.57%. And then we, of course, benchmark that on the following pages. But before I get there, I also highlighted on page 28, the Fidelity 500 Index, which has an expense ratio of, it's rounded here. It's actually 1.5 basis points. Extremely thin margin, right? And one of the investment recommendations, or the changes that I'm recommending, Empower has come to market last year with a zero-cost S&P 500 index fund. So they're first to market with a zero-cost fund of that nature, and so that's eligible for this plan. And so that's a formal change that I'm recommending, and I'm, of course, can send some follow-up information to you if you're like, how are they managing that? Are they, where is that cost coming back to us? And it's not. They're eating any administrative costs behind that offering, and it's, I kind of picture it as a loss leader for them. You know, they use it, obviously, to get their foot in the door with other plans.
And they've never really managed a plan or created a plan before themselves, have they?
The
Empower?
Empower is a record keeper? No, they're a record keeper
Right,
per
so
se.
this is a new venture for them.
Yeah, they, you know, they're, truth be told, it's actually BlackRock that's managing
Oh, behind
the
them?
S&P, and again, Empower's kind of
Oh, following their lead.
swallowing the administrative cost behind that, so they're leveraging BlackRock on the actual, but when you're tracking an index, the S&P index is the S&P, it's the 500 stock, so there's not a lot of decision-making there, you're just tracking an index, so, you know, costs are it's funny, Vanguard had theirs in at 4 basis points, and Fidelity came in, undercut them at 1.5, and now you got Empower coming to market with a zero cost. So, at any rate, that is one of the investment recommendations that I have for your consideration, and that'll, of course, move the needle a little bit in overall plan costs. On page 29 and 30, I am essentially benchmarking for you on a plan level and then an individual cost component level where the township plan sits relative to two universes, benchmark universe. And say that this plan continues to benchmark favorably. We pay a lot of attention to these plan costs, and certainly we want to make sure that this is a cost-efficient feature for people. Cost is one thing, but it's the value of what they're getting to, and hopefully we're adding value as the investment consultant in addition to being in a high-performance plan. Behind those pages, I have included similar exhibits for the retirement health savings plan. And again, in the interest of time, I'll just leave those for your review. The fund lineups are roughly the same. The caveat there is that those new target date funds with the income component, income for life component, are only eligible under the defined contribution plans, the 401A, 457, the retirement health savings plan still owns the Vanguard target date series as its target date option. Into section 4, first exhibit, and you've seen this before, pages 37 through 40. What you're seeing here is the entire fund lineup, and each row represents the investment option stacked on top of its Morningstar category. And if a fund beat or at least met performance given relative to its peer group category, I awarded it a shaded cell. So visually, you can just see, hey, if this is a scorecard, I like to see a lot of color here. And a few of the funds, the ones that I highlighted, are actually a little more anemic. And we've got some recommendations to refresh the lineup in those areas. So there's really 4 fund changes that I'm recommending. I've got those summarized in the recommendations in the back of the presentation. So 4 outright fund changes, and then that S&P 500, I'm not calling that a replacement, more of a shift to a lower cost option. So to summarize this exhibit on page 40, I highlighted for you at the bottom, hey, all right, bottom line, how many of these funds outperformed their category on a 10, 5, 3, 1-year basis? And, you know, decent scores, 79, 81, 79, 76. So when you got 3/4 of the fund lineup doing its job, you know that's delivering good net returns to participants at the participant level. Again, this is just one way to assess performance of the plan, raw performance, not risk adjusted. Okay, that passes the litmus test. Second, let me draw your attention to 41 and 42. And this is an effort by our firm, by me, to just track on a plan level. You know, Michael made the mention of an IRR pertaining to the pension plans. IRR is probably more meaningful, more applicable to pension plans, but I'm also tracking an IRR for these 2 plans. I've done so since 2011, dating back to the time when I was inserted as kind of the lead point on these plans. And so I have conducted an IRR calculation for both the 401A, 457, that's what you see on 41 and 42. And I did so over a 14-year period, or from 2011 to 2024, and 2011 to 2025. I wanted to split those 2 timeframes up because we get benchmark data provided to us from Fidelity and Vanguard for their universe of funds that they record keep. And they get that data to us between February and April, May of each year. So I don't have that data for 2025 yet. I did for 2024, so that's what you're seeing. So just as an example, on page 41, the IRR of the 457 plan from 2011 to 2014, 9.38% versus IRR of 8.8, 8.2%, Fidelity and Vanguard respectively. It's good to beat those benchmarks. Go ahead.
Quick question, on the bottom of this, it says annual net return from 2011 through 2014. It's supposed to say 24?
Thank you for that edit. Yeah,
Okay,
revise that. Apologize.
that makes more sense.
Yeah, I was gonna say, I was having a hard time following that one.
Yeah,
Didn't see any 24s.
Took a blind look at that. Yeah, that should obviously read 2024, 2025. I'll send a revised. Thank you for calling that out. Appreciate that. So same calculation for 2011 to 2025, 9.64%. That's on the 457. Interestingly, on 42, page 42, again, same error. Really, I appreciate you calling that out in front of everybody. It makes me feel really good. Now, the IRR from 2011 to 2024 of 10.7% and 11.3% to 2025. I mean, that's a very meaningful number just because that's pertaining to that 401A, and I know what those initial calculations were based on. You know, hey, can we get 8%? And again, this is plan level, so it's not specific But I know behind that, this means that participants are really getting good returns for a long period of time now, through a full market cycle plus. And that's gonna drive a really great outcome for them. So I'm paying close attention to that number, and I'm happy to be able to report that. Again, I'll provide the accurate time frame on a follow-up slide. Okay. Let me skip to, I want you to see this, page 70, inside of tab 5, page 77. And then you can tell me how you want to use any remainder of our time. But I wanted just for you to see that, hey, majority of the fund lineup, from our view, you know, we do the work, hey, we look at raw performance, but we're looking at each fund in a granular manner. What's the body of work of a fund, risk measures, portfolio change, manager changes, et cetera. Majority of funds doing what they're supposed to do. I am calling out 4 funds because of, I would call it sustained underperformance. And in each of those 4 cases, I'm recommending funds that at least historically have better net returns, and from a cost perspective, they're lower costs. So hopefully a win-win there. And then, of course, the S&P 500 fund change based on a move to lower costs just for the expense ratio alone. So that's my summary. I'm happy to dive into anything, any other questions you may have about the fund lineup. Again, sorry for that error. That doesn't make me look good, so you can strike that from the record.
Everything else is good, though.
Yeah, let's skip forward.
Yeah, I was looking at that thinking, what am I not following?
I just was testing everybody.
All right, so if the committee has any feedback on the recommendation to replace these funds, I'll be glad to hear it. Otherwise, I'm inclined to go forward with the recommendation.
I agree.
Agreed.
Well, yeah, I really appreciate working with everyone here. It's an honor. And again, Michael and Jason, you guys had a heavy workload this year. You did a lot behind the scenes. I hope that's acknowledged. And just from my viewpoint, talking to Empower, they work with other municipalities, and they're always saying how the level of engagement is here is different from other places that they are involved with, and that's a tell. So that's pretty cool to be able to say that. Yeah.
Okay, any other questions for Rob?
Thanks, Rob.
Thank you very much.
All right.
All right, thanks,
Yeah,
Rob. Thanks for
everybody.
sticking around
Yeah.
on the first part. Okay, so returning to our agenda, at this point, it'd be number 8, annual policy review. In your packet were our 4 investment policies. The first is the general investment policy. This pertains to the investing of township operating funds. I am recommending no changes to that. So basically, by us reviewing it today, we can complete our obligation of having reviewed that annually, but I'm not recommending any changes. So unless anybody does have any changes, then I'd recommend that we just move forward with that. On the pension plan trust investment policy, as Brian talked about, the only recommendation that I'm going to bring to the board on Monday is that we change the allocations to trim just a little bit from the equities and bring down the target on real estate more in line with where it's at, and adding a allocation for fixed income of 8% so that we have that cash there in a secure way to be able to meet our obligations for having to start to pay those pension benefits. So that was in your packet today. It'll also be in the packet for Monday. And then on the retiree healthcare benefits trust, as Brian mentioned, the recommendation is to adjust the targets from real estate from 10 to 7.5, from fixed income 10 to 7.5, and then alternatives from 10 to 15. So we stayed 100% there. So again, giving more opportunity for aggressive growth with the alternatives. That is the only other recommended change. to the investment policy for that. So are there any questions? Or I'll also be happy to take questions on Monday after you have a chance to read it again. Okay. Then moving forward to the participant-directed plans investment policy, that's the DC plans. I'm not recommending any changes to that. It's been pretty stable on that point. So again, we have an annual obligation to review it. So I will consider it reviewed unless anybody has any questions on that. Okay, so that completes the policy review. Moving on to new business, we already talked about the buyouts and the liquidity strategy for the pension plan, so that was moved up earlier. The last item of new business is I'm recommending that we add 2 new resident members to the FSC. Currently, the FSC consists of Supervisor McCready, myself, Trustee Barnett, Finance Director Jason Tice, and then 3 residents. Raina, the last remaining here of the 3.
Thank you, Raina.
And David Olson and David Petoskey. So I'm recommending that we add 2 to get some additional points of view moving forward. So does anybody have any thoughts on that? Any questions?
I think it makes sense, especially as we're combining with the Retiree Healthcare Trust into this committee, as well as just getting more engagement. Again, just like David Petoskey brought up today in terms of looking at real estate investment and thinking about it as an opportunity, as well as what Ms. Emmons talked about on how some of the structure regarding the ADCs and those things, they bring a lot of information and resources to us. So being able to get that engagement in our pocket.
Great.
Agreed.
Okay.
Good idea to get more viewpoints.
Okay, great. So we'll move forward with that. At that point, the other thing that Chris just mentioned is that we will be combining the Retired Employee Healthcare Benefits Trust meeting that used to be at 7:30 before the FSC. We're going to combine it with the FSC. Chris is going to step off that committee, so we will only have 3 board members present for the meeting. That will be going forward. So the next meeting of the FSC and the REHBT, Thursday, May 7th, 2026 at 8 a.m. At this point, I'd look for a motion to adjourn.
So moved.
Support.
All those in favor?
Aye.
Any opposed? All right, we are adjourned.